Uh, Good evening to all of you, and of course, good morning to Dr. Raef, who's based in New York, USA, and maybe any others who are joining from the USA. I'm indeed very happy to welcome Dr. Raef Lawson, who's the Executive Director of the Profitability Analytics Center of Excellence, USA, generally referred to as Space USA. Who will be our speaker this evening. So he'll speak on a very, very important topic of causality, essential for effective management systems. Today we have a number of our important panelists whom we have invited. We have Dr. Nuwan Gunratna, who's a senior lecturer from the University of Sri Jayawardhanapura. We have Tiral Roach, our member of the Cost and Accounting Management Standards Board. Mr. Causality Definition, our consultant and also member of the Cost and Management Accounting Standards Board. And of course, our participants who are logging in, because I was just checking the registrations. Those who have registered, there were 277, but I'm wondering as to whether something has happened and why people are still not, whether they are still coming in or whether there is some problems faced by, because we are having certain power cuts in certain areas, Dr. F. So I don't know whether that may be a reason. But we will get started. I'm sure a lot of them will join later. Just to say a few words about Dr. Raef Lawson, who is, of course, not a stranger to all of us. He's an accomplished executive and thought leader with proven success in designing and implementing world-class research and policy programs. So I think that's, we are very happy that we have someone of the very highest caliber who will be delivering the address today. He has extensive senior leadership experience in diverse settings, including for-profit and not-for-profit organizations. He's an award-winning author, global speaker, and media contributor in the areas of performance management, sustainability, business ethics, corporate governance, and accounting education. So when we talk of accounting education, I'm also happy to state that he is a member of the academic board of CMA Sri Lanka. So we are indeed having a very erudite scholar who is going with us on our education side. Then he's also a recognized collaborative leader, creative, innovative, results-driven, focused on strategy, innovation, and execution. He has a Doctor of Philosophy, he's a Master of Philosophy, and a Master in Business Administration from the Stern School of Business from the New York University. He's also in the professional field, CPA, CFA, CMA, and of course, a fellow member of the Certified Management Accountants of Sri Lanka. So we are very, very thankful that he is present with us, because Dr. F was with us some time back, where he came and addressed our Global Management Accountants Conference. So at that time, we were able to grant him the fellowship. So we are very happy that, in fact, he's using it. That's a great, I think, greatness that is there, where we are also getting the coverage. So he's been with the Institute of Management Accountants of USA. He was a Vice President Research and also the Professor in Residence. He's also being a visiting professor in many universities in the USA and also overseas, and quite involved in the academic area. So with that introduction, I would invite Dr. Raef Lawson to speak to us on this important topic. As I said, he's currently with the Profitability Analytics Center. So he's retired from IMA, and with the Profitability Analytics Center of Excellence, USA, and doing a great job. I think we need the profitability analytics, and I'm sure this is only a start of one of the very many seminars that they'll be conducting for us. So the topic today is causality, essential for effective management system. So may I now hand over to Dr. Raef Lawson to address us.
Great. Okay. So let's see. There we go. Okay, well, it's a pleasure to be here today. I'm always happy to support the activities of the of your institute. We've gotten back a long ways, as you mentioned, and I'm always impressed with the work that the institute is doing. So, again, glad to be here today and support your work. What I want to talk about today is causality, and it's a topic that's really very near and dear to my heart, and very integral to the work that we're doing at PACE. Many CFOs today encounter challenges of poor data quality, inaccurate budgeting and forecasting, a lack of ability to collaborate cross-functionally, an inability to transform business data into critical insights. And we've developed at PACE our Profitability Analytics Framework that Lucky referred to. And this framework helps develop decision useful information through the use of causal business modeling. And so this idea of causality is key when developing effective performance management systems. And it's what I'm going to be talking about today. So I wanted to start off by talking about the truth. And what is that? It's especially as it relates to information for decision making. Decision makers need accurate decision support information that reflects the truth, right? Or in other words, that it's a fair reflection of the realities that surround the decision that they need to make. And so what is truth? Well, this second bullet point indicates it's the property of being in accordance with fact or reality. It's typically ascribed to things that aim to represent reality or otherwise correspond to it, such as beliefs, propositions, and declarative sentences. To be useful, information should send decision makers in the right direction and not cause them to go in the wrong direction. It's important to realize that the truth, in terms of information, does not mean precise measurement, but just be a fair reflection of the economic realities that impact the decision. So, as accountants, we sometimes shy away from things that we can't measure accurately or precisely, but that's often not the best avenue to take. So what information should we provide decision makers? And that's a tough question sometimes, but it's a key question when we're deciding these performance management systems. And why is that? It's because the realities that surround us are complex, right? They're so complex that they're beyond the capabilities of us humans to fully understand them. And we think of these situations in our everyday life. If we think about how does the economy work, how do we raise our children, how does the universe work, what kind of diet should we eat to live long and healthy lives? So all these are all pretty complicated, but we live in a world where we have to deal with answering these questions. So what do we do to deal with them? We create models, right? They're just internal versions of what the external realities are. And then we use those models to guide our actions, to help us make decisions. So we create models by how? By identifying first what we believe are the key elements of the reality, and then importantly, by determining how those key elements relate to one another. And causality is the driving force understanding those relationships between the model's key elements. So, it's what we want to understand, though, is when we're talking about causality, we're not talking about correlation, and it has no no place in the decision models that we develop. So what is causality? It's defined as the relationship between managerial objectives, quantitative output, and the input quantities that must be or have been consumed if the output is to be achieved. And that's the definition from the IMA Conceptual Framework for Managerial Costing. So that's quite a mouthful. But what does that mean? It means that when we're building our revenue, cost, or investment models, again, that we need to make decisions, we need to look at the cost and effect relationships to describe and quantify the relationships that exist between those elements of our decision models. And we need to understand when we're doing our modeling that causality needs to be based on resources, the consumption of resources, the operations, say, of our organizations and its processes, and not just money, right? And that's a mistake that a lot of organizations do. They just go right to modeling based on monetary amounts. So again, too often companies forecast their revenues as shown in this top of this slide here. They use non-causal forecasting. So for example, their customer might give them a forecast of the volume of goods that they'll purchase in the coming period. They'll attach some monetary unit to that volume forecast, and that's our forecast. But if you don't understand how that volume forecast got put together, you can't make adjustments as time goes by. You can't see that perhaps the customers were overly optimistic with their forecast, and that perhaps you might need to adjust it down. So if you don't understand how the forecast was put together, you really don't know how to respond to events in the future. So a causality-based alternative to that would be what's shown in the bottom portion of this slide. It would be to actually look at the causal factors, right? Look at, say, what the World Economic Forecast is, and then what would that be? What would be the impact of that, the world economic conditions on your industry, say the automotive industry, and then forecast the volumes of cars, for example, or whatever, in the industry. Then use that, see how that affects the volumes of business that your customers might have in the coming year. Look at the impact of that on your various companies' programs, and then only at the end of that line of reasoning, of that line of related cause and effect events, then monetize that. Which, by monetization, I mean again attaching monetary units to operational volumes to get your financial forecast. So there's two types of causality: strong causality and weak causality. Strong causality is where the cause and effect relationship can be quantified and traced using measurables like hours, units, transactions, and headcount. These are relationships, cause and effect relationships, that you can actually trace. So with strong causality, for example, you can see where a person's working, you can see the parts machines making, and again, it's a concept that applies not only to manufacturing but service industries as well. So in a healthcare facility, for example, you can see the nursing care that's being delivered to patients. You can trace the support of the customers in a, say a telecom situation. So there, again, these are numbers that you can trace, transactions you can trace to link the cost of an activity and to the reason why it's there. And this is as opposed to weak causality. It exists where there's a clear cause and effect relationship, but it can only be inferred, right? There's no direct quantitative measurable that links them together. It's what we call attributable, right? These costs are attributable to a group of activities or a group of resources or a product, but there's no specific transaction that we can use to trace them to those cost objects. So again, there's causality, but again, it's difficult to quantify the relationship. So when would we use this concept of causality? Well, we can use it in assignments and in projections. So in costing, causality should be used to assign cost and resources. It should be used to assign support costs, support resources to the resources that actually consume them. It should be used to distribute things like human resource department and accounting department resources down to the resources that consume them, like production people or field service personnel. And then you can use causality to assign those operational quantities and costs of those resources down to the final cost objects. So we're talking about basically a multi-stage assignment of resources and costs to get to the cost of the final cost objects. But perhaps the more useful and valuable use of causality is in projections. Causality can be used to project the results of actions being considered by decision makers to see what the future would look like if different courses of actions are pursued. And it can be used to support, for example, planning and budgeting activities. And finally, causality can be used to support organizational learning, right? It can be used to understand why a good thing happened and how to repeat it, or maybe after the fact something didn't go right, something bad happened, and we want to know how to avoid it. If we've used causal modeling, then we can understand why that happened. If we look at the traditional P&L statement that we prepare under financial accounting, we may do our variance analysis and see whether we've had a good period or a bad period, but it really doesn't provide information that managers need to understand why they had a good or bad period, because there's no causal understanding or no causal modeling behind that. So in cost modeling, the place where causality comes in is when a projection is going to be used to determine the total cost of a particular volume and mix of business. So starting at the bottom of this example, of this slide rather, strong causality, right? The ability to identify a quantitative relationship drives much of the consumption of resources. And then these get combined with fixed and budgeted resources to get the total cost of consumed. So these resources are then monetized to derive total costs, I mentioned. But both strong and weak causality should then be used to assign this total cost to the support department costs. And those again assigned through causality to get the total cost of resources, and then those are assigned to the cost objects. So we want to talk about the use of causality in projections and forecasts. Strong causality uses operational measures to project the resource and activities required to support a particular volume and mix of business. And again, causality is understanding cause and effect relationships within the organization. So we can picture in our mind a chain of activities in our organization. There's a number of actions that are contiguous, that are linked together to result in a particular outcome. An example here, a distributor receives an order from a customer. What will that precipitate? It will cause a chain of activities, starting with an order entry activity. From there, a pick list will be prepared. The order itself will be picked, and the shipment will be packaged. The logistics for that will be arranged. That will cause the order to be shipped, the order to be invoiced, and finally payment received. So if you understand these causal relationships and have this causal modeling, this causal modeling, you can use the number of orders received to be able to project the level of work that would be required for each of these activities at each of these stops along the chain. And of course, in any particular organization or other processes, it can be more complex or perhaps simpler. But again, it's the number of orders that's the triggering event for this chain of events. And that number of orders as well should be causally related to the revenue forecast, which hopefully is also based on understanding causal relationships. So if we understand, again, our revenue forecast, we'll understand what number of orders received or forecast that. You can forecast the level of activity for each of these activities and engage in more effective forecasting. So here's a little more detailed example that we'll go through. It's a manufacturing company that incurs a variety of costs that it needs to project. And so you've got all sorts of costs here. We have operating supplies, we have purchase maintenance costs, we have gas costs, electricity costs, we have this other side, but variety of labor-related costs, paid break costs, vacation, holiday, PTO costs, health insurance, state employment, retirement costs, straight time wages, overtime premium costs, a variety of social program costs here. And should this organization, how should this manufacturer forecast these costs? And the key to forecast them should be to understand that each of these is not disassociated from each other. They're all connected by causality and triggered by uptime hours. if we have an understanding of these relationships using causality, we can capitalize on that and come up with realistic projections. Okay. So I do want to, if you're like me, you're probably taking screenshots or trying to write down some of these exhibits. And at the end of the session, I'll give you an email link, a web link to a document that contains a lot of this. So you don't have to try to copy down all of this information unless you want to. So here's in this diagram, we're showing the factors that fill in between these boxes. So we're starting with uptime hours, and uptime hours drives things like operating supplies and purchase maintenance. So if we know, for example, the operating supply cost per hour, and we know our uptime hours, we can forecast our operating supply cost. And the same thing for purchase maintenance. For our gas consumption, for example, we know our gas consumption per time hour to get our gas consumption in units. We know our gas cost per unit and can then forecast our gas cost. The uptime hours also determine the number of labor hours used. And how would we compute that? Well, we know the size of the crew that we need for our various pieces of equipment. We can adjust that for an efficiency factor to get the total productive labor hours required. And there's one more factor here that comes into play, and that's the head count. So between these two factors, that will determine the straight time labor hours that we utilize, as well as the overtime hours required, and in turn, all of these other costs can be deduced. So again, we want to forecast these various costs, and we see that if we understand the causal relationship between all of these and the two drivers of uptime hours and headcount, we can accurately forecast those. So this is the same example where we're putting some numbers to it. The numbers in the gray boxes are the calibrations you can make in the model. It shows the relationship between the factors, between the uptime hours and the production hours that go into the cost of the hours. So in this example, we're assuming that our equipment will have 10,000 uptime hours. And looking, for example, at the equipment, its machinery resource, if the average crew size is 2 people, then theoretically we need 20,000 man hours. If there's an efficiency allowance or indirect activity allowance of 40%, meaning we need 40% more hours than theoretical, then the required production hour would be an additional 8,000 hours or 28,000 hours. And we can match these required hours against how many hours are required, and also considering the head count, we can determine the amount of our straight time hours that we're paying for our employees, and also the amount of overtime hours. And we see that using this causality-based modeling and the number of typical hours that our employees work, we would need 14 employees here to satisfy the number of labor hours required to man these machines and only have an acceptable overtime percentage. And we see that all the way on the left in the middle there, that it's overtime percentage is 5.3% of our hours. So if we had less than 14 employees, production employees, our overtime percentage would be much higher. And if we had more than 14 employees, there would be excess labor resources. So 14 is the optimal headcount in this example. So that'd be, again, we're using this operational causal modeling to help us plan for future operations. So I just want to note that in the lower right-hand corner here, in these salmon-colored boxes, we can deduce what our total equipment costs will be. It'll be $50 an hour, and our product labor costs will be a little under $1 million, or about $48 per labor hour. So using causal-based modeling like this, and understanding the chain of events, we can engage in scenario planning and see the impact of changes in planned volume on our processes and on our costs. So this is the same example, but instead of needing uptime 10,000 uptime hours, it's been changed to 12,000 hours. And the causality, all these causal relationships, again, this is actually based on an actual company. The numbers have been changed to anonymize their operations, but it's basically based on an actual company. And if we trace through the causal relationships to get to head count, in order to again have an acceptable percentage of overtime labor, we see that we'll need to increase our head count from 14 employees to 17. And we see that, again, looking at the total cost, our equipment costs has gone from $50 an hour to $45 an hour, while labor cost per hour has stayed about $48 an hour. And that makes sense because our labor profiles remained about the same, with about the same percentages of straight time and overtime being consumed. And we can see that, again, our total costs went from about $950,000 to $1.15 million, or increased about $200,000. So this is, again, using causal modeling, gives us the ability to accurately forecast the impact of alternate scenarios of changes in operations and volume. So we can do more than that. We, because we understand the chain of events, we can look at whether there's any way we can make improvements in our operations to become more profitable. Where should we focus our attention? And in the prior 2 slides, we'd assumed 40% allowance for inefficiency or indirect activities. Well, what would be the impact if we lower that 40% to 20%? Maybe our changeover time we can reduce, or our maintenance we can become more effective. What would be the impact of that on our operations and on our costs? Well, if we put in 20% to this model, we see that, again, to keep our overhead percentage low, but without having excess labor resources, we can reduce our headcount from 17 to 14 people. So that's quite a savings, quite an increase in efficiency. And we see that down here in the lower right-hand corner, that our labor cost per hour drops from $47 to $41. And we can also see the incremental impact on our total cost. So again, the basic idea is, or the key idea is that there are these chains of activities throughout the organization that can be modeled based on causality, and they can be used to be able to do better projections and engage in scenario planning like this, which again provides very important, valuable information to managers. So we also need to worry about whether we have the capacity to carry out the operational plan. And one of the corners of our investment model might look something like this. Here there's 3 scenarios for our company. In each of these scenarios, well, we're assuming, of course, 365 days a year, 12 annual holidays, 10 shutdown days. In each scenario, there's 4 machines that work 2 shifts a day. Each shift is 7.5 hours a day. So for each scenario, there's 21,900 hours available. There is a variety of reasons for downtime, including weekends, holidays, setup and changeover, maintenance, and other, which totals 49%. So we have non-productive hours of 10,740 a year, total productive hours a year of 11,160 in each case. So if the productive hours that we need in that first example that we looked at was 10,000, we see that that is a scenario, a situation that our equipment can handle. And it'll be 1,160 hours surplus. In this second example that we looked at, where the production hours required was 12,000, we see that we would not have the productive resources, productive capability to meet that. We would be 840 hours short. And then in the last case, scenario 3, if we only needed 800 hours, again, we would be fine there. So, okay, so again, the 12,000 hours can't be obtained with the current equipment under the current shift structure. So what should we do? Well, because we have this causality model, we can look at various ways to obtain the additional capacity that we need if we need a total of 12,000 productive hours, machine hours. And in scenario 2A here, one of the alternatives would be to buy an additional machine. So we would have 5 machines in total. Scenario B, we might say, well, instead of buying a new machine, what if we added some weekend work? So again, the percentage of non-productive work due to weekends has declined. And then scenario 3 might be, well, what if we increase the average shift from 7.5 hours to 8.5 hours? What would be the impact of that? So each of these alternatives would have an impact on our costs, and we can use the causal model to see what the impact would be. And we see that the production hours available obviously increases in each case, we can meet the 12,000 production hours required, and we have some surplus left over. So then once we have these scenarios, we don't stop here. We can run the cost part of these changes back to our cost model we just looked at, match, and then see what the cost impact would be, run that back through our capacity model, and again, determine what would be the most effective scenario or alternative to choose. So this driver-based planning is obviously from a manufacturing scenario situation, but it's equally applicable to service industries. And this is an example from a long-term care facility. Again, another actual company, but simplified. The drivers of their costs were the volume and mix of residents and their level of acuity, right? Their health, and that drove the need for nursing services. So we see that there are 4 categories of residents: subacute, dementia, skilled nursing, and assisted living. And within subacute, there were 4 subcategories: base level, level 1, level 2, and level 3. Based on published studies, you can determine the amount of nursing resources required for each category of patient. There are 3 types of nursing resources: regular nurses, LPNs, licensed practice nurses, and nursing aides. And the figures in this yellow box are the number of hours of each of these nursing resources required per day for each type of patient. So based on, again, these are causal relationships. We know that if we have a subacute patient at the base level, they will require on average 1 regular nursing hour per day. And if we know the total number of residents that we have or that we're projecting, we can then forecast the total nursing hours required for each type of nurse. So in this case, we would need 22,660 regular nursing hours. We would need 29,350 LPN nursing hours and 71,050 nursing aid hours. So from a capacity standpoint, this model can be used to determine whether there's sufficient resources in the market, maybe, to meet our projected demand. In this case, the capacity for nurses was the entire local market. And in reality, the models that you use can become more complex, right? The nurses, the nursing resource can be drilled down into full-time and part-time nurses with benefits and without, et cetera. And we can use similar models to can be constructed for other services at this facility, driven by resident day, such as laundry services, dietary services. Again, for each type of resident, there's a causal relationship, and we can project the resources that they would need. So there's some key points that I wanted to mention And the reason why focusing on causality in doing projections is that it ensures that you focus on the most critical factors that lead to an outcome, and that you don't focus on the ones that are not important. You've basically identified the key factors in the consumption of resources. You've been able to measure them. You've identified the key relationship, and you've developed basically a roadmap for spotting the factors that need to be modified to improve organizational performance. And again, having these models provides the opportunity for continuous improvement, right? As time goes by, you can see why perhaps you didn't meet your projections, because you understand the causal relationships. Or if you've done well, you can understand why you did perhaps better than you had projected. So I next want to talk about using causality in assignments. One of the things that you need to keep in mind is that when you do incremental cost analysis, the assignment of cost is irrelevant, right? The analysis, that's the analysis that supports most business decisions, incremental cost analysis. So you just need to project the costs, what's the difference, what's the delta, and there's no need to worry about cost assignments. But assignments are only needed when determining the total resources and costs required to perform a function or execute a process, to produce and deliver a product, or et cetera, or maybe the cost to serve a customer over time. But again, when you're doing incremental cost analysis, which is the most frequently used type of business decision, the assignment of cost is irrelevant. So causality in measuring incremental costs is just the left-hand side of this diagram. And we looked at this diagram before, where there was had to worry about strong and weak causality. Well, again, if we're looking at incremental costs, we don't need to worry about weak causality where there's no direct quantifiable relationship. We're just looking at the direct consumption of resources that can be directly traceable to products, customers, and services. So when we're using causality in assignments, we can use strong causality when there's measurables that we can use to distribute costs. So, for example, for human resources, we might want to distribute that among the resources that consume that department's resources, and headcount would be a good way to make that to trace that cost. In a similar way, building and grounds, the consumption of that resource can pretty clearly be traced directly to the square footage of each resource that consumes that buildings and grounds resource. Equipment and maintenance, equipment hours is a good way to assign that cost. And supervision headcount might be an appropriate basis for allocating that cost. But we want to note, as it says here on the right-hand side, that even though we're using these bases for allocating our costs, it does not mean that a linear relationship exists between the resources, but that the source support resource is a function of the consuming resource. So, for example, if our head count goes from 100 to 105, that doesn't mean HR costs resources consumed will increase by the same percentage. But there is a direct relationship, and if we increase from, say, a headcount of 100 to 200, we would expect HR to increase considerably. So here's an example of cost assignment, looking at human resources. So in the previous nursing home example, there was a human resource department with a total cost of $300,000. And that cost could be allocated to the various activity centers. We had mentioned that headcount would be a possible good way to allocate that cost. And here we've broken down the headcount into both salaried and hourly staff, where you look at the total headcount. So plant operations has 4 salary employees, 3 hourly, a total of 4 employees total in that department, of a total of 174 in the nursing facility. That accounts for 2.3% of the total, and we can then allocate that percentage of the 300,000 to plant operations. So that's a very straightforward allocation. We can make a further refinement of the allocation if we have the information by perhaps considering an additional factor. And in this situation, the nursing facility understood that not all heads were created equal, and a further refinement of headcount was desirable. It turns out in this example that each hourly employee needed about twice the amount of HR resources as the salaried employees. And there were a variety of reasons for that. There was a greater turnover in hourly employees. There was complaints about the amounts they were paid on specific days. So again, the hourly employees consumed about twice the HR resources as salaried employees. And so we can attach these weights to the number of employees, get a weighted head count, get, in this case, plant operations had a weighted head count of 7 out of a total of 322. That was 2.2% of the total, and we can get a weighted allocation then of 65-22. But again, the thing to keep in mind is this allocation is still based on a strong causal factor, which was headcount. Here's another example from maintenance. Now, obviously, if you have a maintenance department with a couple of different types of machines, they all don't require the same intensity of maintenance maintenance effort. If you have a complicated machine, the maintenance will probably require more maintenance hours than a simple one. And we can use, again, this kind of a weighting to more appropriately allocate costs. So in this case, the equipment was divided into 7 different categories. The intensity of maintenance was estimated on a range from 1 to 6, a scale from 1 to 6. And the equipment uptime hours was, these weights were attached to the equipment uptime hours to get the weighted equipment hours, and then the percentage of the total was total cost was allocated to each equipment category. So I want to talk about the use of causality in assignments further. We talked about the use of strong causality. We can also use weak causality. in assigning the cost of support resources to the resources that require their support. And again, this is done when causality can be inferred, but there's no measurable operational quantity that can be calculated, or perhaps materiality makes using operational quantities overkill. So if we have a relatively small cost, it may not be worth the effort to use strong causality and do the actual detailed calculation. So here's an example of use of weak causality in assigning costs. It's a purchasing department with, say, a $300,000 cost. It's this company manufactures a variety of has a variety of activities. It's listed here, and we know that the costs are related to the stuff that each activity center consumes, but there's no strong link to the various items of the purchasing department of its cost to the items purchased. So we'll just use our best estimate of the most qualified individuals to estimate the percentage of the purchasing department costs consumed by each activity center. So we see the Deco Plastic Center consumes approximately 15% of the purchasing department activities, would allocate 15% of that cost to there. So this is not a precise allocation, and as I said way back at the beginning of the presentation, that's fine. We need to not really be hung up on precise measures, but the important thing is to understand that by allocating this cost of the purchasing department to the activity centers in some way using weak causality, we're not adding it to, as many companies do, to some general overhead rate, which would then just allocate it everywhere. Here, we're making sure that the purchasing department costs are allocated to the right cost objects, and so the allocation is done appropriately. So we know, for example, that the Deco Plastics Center consumes about 3 times as much purchasing resources, electronics, and we're allocating the costs again appropriately. So again, we can use weak causality to make sure we allocate costs to the right cost objects. And sometimes, it's even more simple than that. Here's an example of a company that does $500,000 in product engineering and has 2 product lines, A and B, which have sales of $10 million each. And again, this is not a situation where we're monitoring the work of the employees in this product engineering department. They're not filling out time cards. We're not looking at the resources purchased by the product engineering department. But the best estimate of the most qualified individuals is that product line A consumes about 20% of the product engineering effort, and B about 80%. And so we would allocate 20% of this $500,000 of product engineering to product line A and the balance to B. So again, it's weak causality, but it's good to get an estimate to link these costs to the appropriate cost objects. So strong causality is evidenced by the ability to trace operational quantities and cost of resources to managerial objects. Typically used, by many companies are quantities like direct labor hours, and those are used for production and direct service labor related costs. Another driver would be machine or equipment hours, and we'd use that for production and equipment related costs. But there are other quantitative measures as well that we can use. And we looked at using resident days, right, as the driver in the long-term care facility. If we have an exhibit tour management company, we might use contractor events. If we have a distribution company, what determines the cost of our different orders? Well, you know, an order with a lot of items will be more expensive to fulfill than one with only a few items. So perhaps the line items picked would be a good driver there. A manufacturing company, maybe in-process moves. Financial institution, maybe ATM transaction. Again, you need to find out what the appropriate measurable is for an organization and assign the cost objects using that. So we can also use weak causality to attribute things where there's inferred costs, where you don't have any way of directly measuring output. So we can use weak causality to associate resource and activities involved in marketing to our various customers, for example. You know, we don't know if we have our marketing staff selling to our various products to our customers, that we may not have a way to quantify how much time we spend on each product, but we can estimate that. And again, use weak causality to allocate the cost of marketing to our products, cost of our marketing staff to our products. It could be use weak causality to associate resources in supporting various product lines and sell those products. We could use weak causality in associating extra costs involving dealing with difficult customers. Some customers may take a lot more time on our customer service support lines. They may take more, they may return more products and so on. We may perhaps not be able to quantify that relationship precisely, but again, we can use weak causality and estimate that. And again, it's important that we do use causality to trace as many of our costs to our cost objects, so we don't just lump all of our costs into some general overhead rate that we allocate to all products. So it's a word of caution. But when it comes to certain decisions, it's important to be able to assign costs. But many others where it may be irrelevant or even worse, deceptive. And you know, we have the mantra in management accounting that there's different costs for different purposes. And we need to understand where and when to use each of these, or each one is just as important as the cost model used to create the cost information. And as I just mentioned, in pricing decisions, any cost that is not assigned to a product, service, or customer is subconsciously added as a percentage of those costs that are assigned. So we're just basically spreading those costs over all products or services or customers, which is not a good practice. So an example that we want to talk about is use of tack-on rates. So we can use these to develop, again, a tack-on rate. Basically, we're saying that, again, that 20% of our product engineering is going to be allocated to A and 80% to B. So if we, based on the what we had talked about before, we're going to allocate 100,000 of the engineering to product line A. If the sales are 10 million, then we're going to allocate tack on a 1% of product engineering costs to get an idea of the total cost of product line A. And the same with product line B. We estimate 400,000 of engineering costs are attributable to that, or 4% of sales. And we might want to tack on 4% as to get our total product cost for product line B. So it's useful. We wanted to know the total cost of our products, to know that our prices are covering the products of the products in that line. But again, we need to know, be careful about what we're doing and aware of the implications of that. So even for weak causality, the base that you use matters. And this is an example, an SG&A example, where the company purchases $1 million worth of outside goods and services. It then incurs $1 million of, it then performs $1 million worth of activities within the organization for a total cost of $2 million. It also incurs $200,000 of SG&A costs, $20,000. So if we allocate, as many companies do, this SG&A cost based on total costs, we will be allocated based on, we will get an allocation rate of 10%. But it might make more sense to allocate the SG&A based on the activities that the organization performs itself, the 1 million, to give us an SG&A rate of 20%. So let's just look at a couple of examples here. There's 4 different products here. In product A, $3,000 of outside goods were purchased, $7,000 of costs were performed internally for a total cost of $10,000. In product C, $7,000 of outside goods were purchased, $3,000 cost, internal costs were incurred for another total cost of $10,000. So if we were allocating SG&A based on total cost, we would be allocating the same amount of SG&A to both of these products. But does that make sense? Does that really reflect a causal relationship? And the answer is probably no. The purchase of these outside goods probably doesn't require additional activity within the organization, and a better alternative would be to allocate the SG&A based on the cost performed by the organization using the 20% rate. So it's going to be $1,400 for product A and $600 for product C. And we can make additional comparisons, but I think I'm running out of time, so I will move on. So in conclusion, if revenues, costs, and investment models are to be effective in supporting business decisions, they must reflect economic reality. And to reflect economic reality, they must be based on causality. And so how all elements of the organization link together to lead to its financial goals. I think I'm running out of time, so I just wanted to show this. This is the Raef's Profitability Analytics Framework. And there's a lot more on our website, which I'll show you in a moment. But underlying our key concept in the framework is this use of modeling. So it's based on modeling revenues, operations, investments, and this is use of causal business modeling. That's a key concept in underlying the framework. PACE, we're just a nonprofit community of professionals and academics. We are basically a think tank. We develop a lot of, we do webcasts, blogs, ebooks, we do case studies and white papers. We have interest groups and a forum for our members. I invite you to go to our website, profitability-analytics.org, and check out our additional resources. And if you found this session today informative, please check it out. So as I promised, there's an ebook on our website. You can go to profitability-analytics.org/ebooks. We have a variety of ebooks on that page, but one of that is why causality is essential for effective performance management systems. And they'll have a lot of what I talked about today. And if you like, again, our content, please follow us on LinkedIn. This is our URL, but you can just search for the Profitability Analytics Center of Excellence as well. So I think I've run out of time. So with that, I will stop sharing and be willing to answer any questions you might have.
Yeah. Thanks, Dr. Raef. I think you have gone through in very, very detail. And what I will now do is I will ask, I don't know, Nuan, are you there, or because you were having some problem?
Yes, Professor Watawala, can you hear me?
Yeah, I can hear you.
All right. Yes, actually, I'm sorry, I'm not in a position to switch on my camera because I'm having the power cut.
Okay.
Right. Yeah.
I've told Tyrell, so he will handle it. And maybe we will get initially a few comments from your side and then take the Q&A. So now that you're online, do you have any questions or comments?
Yes, actually, I have a question connected to a comment. So, Dr. Raef, I think your presentation is interesting and insightful, and I'm sure that this will be the causality is an eye-opener for many of our members. So, as you mentioned, I guess that the causality can be used in projections, cost forecast, and even in organizational learning. And even I guess that this is a notion that we can use in activity-based costing, ABM, budgeting, variance analysis, pricing, and even in balance scorecard. So that I see that the uses of causality are immense. So that now when it comes to the Sri Lankan context, one of the biggest challenges that our business sector faces here is the uncertainty due to various reasons. So it could be currency depreciation, high level of inflation, the changes in policies, etc. So how do you how can we use causality for cost planning and other projections when we are faced with high level of uncertainty?
Yeah, that's a great question, and that's certainly important, not just in the Sri Lankan context, which I'm sure it's critical, but globally now, it's such uncertain times. And that's really why it's so important that organizations have these causal business models and so many, and FP&A, financial planning analysis, has for many companies a very poor track record. And we make these projections of our organizations and for our organizations, and they're so off the mark. And I have one consulting colleague that says that even large companies can't forecast cash, and that's that's a huge problem. And why is that? Because many companies have FP&A models that are financially based and not linked to their operations, not linked to their operational models. And our profitability analytics framework, and I flashed it up on the screen there, but one of the key concepts is that your modeling should be based on your operations, and that's really what causality is all about. And so, if there's uncertainty regarding the future economic environment, that's where scenario playing really is critical. And so what would be the impact of inflation doubling? What would be the impact of interest rates going in one direction or the other? And that's if inflation goes up, what's the impact? if you have this causal model, you can say, well, if interest rates go up, then my customers, this impact on my customers, this will impact on my sales and my revenues and so on. And that's all linked into, your model of your operations and so on. So the having a tool, right, that can enable you to do accurate forecasting is critical. And that tool needs to be a causal-based model. And if you just have, a traditional financial model that doesn't really include an understanding of operations, you're not going to have the tools you need to make good decisions.
All right.
And I think the consensus is that the economic environment in general is not as stable as it once was, and more companies need to go to scenario-based modeling.
All right. Thank you, Raef. Thank you very much.
Okay, Tyrell, maybe you can ask any questions and also go through the Q&A.
Yes.
The questions that have been posed to Dr. Raef. Yeah.
Dr. Lawson, yeah. So before going to the questions, I just want to add on, in our cost and management accounting standards also, we included causality as a principle, because it's that important for standards and for our management accountants also to practice.
That's great.
I have worked in many companies, and of course they do some sort of causality, but not into the depth Dr. Lawson has given us here today. I think it's a very valuable lessons to our management accountants to use it. And I think on the first instant it will be difficult, but if you can practice it and of course polish it up, it's a very valuable tool, because our management accountants today are required to do, like Dr. Lawson said, not only projections, forecasts, and budgets, but they are required to give predictions. They are required to speculate. They are required to do insights. So when these kinds of things come to them, as a professional management accountant, I think this concept is very valuable in addition to the other principles. So I hope all these management accountants who have connected with us today use this concept, because Dr. Lawson has clearly explained it, how to do it, and they use it. So we'll go to the question and answers of what they have asked.
But I just wanted to kind of elaborate on that. I mean, that's a great point. I'm so happy to hear that causality is included in the framework. And we talk about the future of finance and the finance professionals, and becoming strategic business partners with the rest of the organization, and how and our the remit of finance professionals in the future is going to be helping create value within our organizations. It's not just going to be delivering the financial statements. How can you deliver insights if you don't understand the operations of the organization? If you just look at everything as a percentage of sales, that's not delivering insights. But if you have these causal models, you can say, as we went to that one example, what if I increase the number of machine hours from 10,000 to 12,000? Then I can see the impact on the number of employees, impact on costs, and so on. That's delivering insights to the organizations. That's where we're going to be adding value.
Good. So we'll go to the questions. Sandun has asked, what is the relationship between causality and customer satisfaction? Because most of our examples were on the production side, but how does it connect with the or measuring or having costs to improve customer satisfaction?
Wow, look, that's a great question. So obviously you need to think that through, but I, which might be a little hard to do on the fly here, but I would say that, so the causal models that we looked at today were cost-based models, right? And in our profitability analytics framework, we talk about not only cost-based models, but revenue and investment models, the whole gamut of factors that affect profitability. So you can build revenue models as well. So if we and link that to your your resource models, and so we can look at customer support personnel, and that the number of those potentially could impact the customer satisfaction, and customer satisfaction then can impact the the volumes of our sales and so on. So the key is to find the appropriate cost drivers, right? Our revenue driver. We also talk about revenue drivers as well. And so customer, once you identify, and that's the great thing about these models. And as I mentioned, by building these models, you're identifying the key factors in your organization. What are your KPIs? And customer satisfaction might be one of those, right? So again, you can't say precisely what the relationship is between number of customer support employees and satisfaction level, but there's clearly a relationship there. So weak causality there, and you can model that, and that'd be a great example, of a revenue driver, and you can include that in your modeling of your revenues. And again, that can then be linked into your operations and your investment models to help optimize the operations of your organization.
Yeah, excellent answer, Dr. Lawson. Yeah, I think our management accountant would have understood that. And then another person is asking, I think he felt that our presentation was most on performance measurement, but not on performance management. Is that correct, or do we need to explain that, Dr. Lawson?
It was more on performance
measurement rather than performance management.
Oh, no, absolutely not.
Yeah.
But no, I mean, again, think of the example where we had the one organization that needed $12,000 of 12,000 hours of machine hours. And then that third slide was what we were looking at. How were we going to achieve that? And again, we said, perhaps I didn't spend enough time on it, but we said, well, understanding that causal model, seeing all the factors in there, we could examine the options that we have. And we looked at maybe reducing the number of indirect inefficiency hours from 40% down to 20%. Well, that wasn't, that is one option. Another option, if you look in the next slide, was increasing the number of machines, or maybe operating the machines on the weekends. So that's performance management there. How are we going to manage our operations to be most effective? And I didn't have time, but then I said, well, once you have those options, then you need to feed that back into your cost model to see the cost impact. So it's a holistic system, and that really is that's the crux of performance management. We're saying, what are our options? How can we get the insights that we need to most effectively operate our organization? And by having these models, we can make we can make that decision in an informed manner.
Tiril, can I ask one question?
Yes.
Yeah. Raef, now you gave this example of the electricity sector, but that was really based on the labor. But what the problem that we are now facing is, of course, the electricity prices going up. That is mainly based on the type of generation. You see, we have the hydro, then we have the thermal consisting of coal and the fuel, and then of course we have the solar and the other areas that are coming in. If you are going to build a causality model for this, how do you think that, because there are certain limiting factors now, although say hydro maybe there are certain limitations on that, then maybe even on the solar there are certain limitations, and then of course they will use the thermal. As a result, even in the thermal, the mix of coal and fuel, because coal is the cost is cheaper, but fuel is more. Is there any sort of way that one could try to link up the type of generation?
So is this more at a societal level than an organizational level we're talking about, or are we talking about, I mean, I'm sure you could apply these concepts at multiple levels, but you know, again, the similar concepts would apply. You know, you're to generate energy, you need a certain infrastructure, certain operations. There's cause and effect relationships and outputs that you can then monetize. And you know, I didn't go into it with our profit analytics framework. We talk about profitability, but it also can encompass societal and environmental objectives as well. So we can look at, you know, which are these are cleaner, and look at the cost of generation. And, you know, again, it's based on operational models. So there's, you know, I'm sure there's constraints on the amount of solar power you can generate, perhaps the amount of hydroelectric power and so on. So it's really a very similar type of situation that you can use. And you know, in the company example, you know, one of the alternatives, if you're looking at energy consumption, might be investing in energy saving devices. And then again, what's the impact of that on the operations? Does it affect you know, output? Does it affect you know, hours of operation and so on? So you know, maybe there's peak demands and off-peak demands for electricity, and so all of that can be modeled. I mean, I today just covered modeling at a high level. I mean, it's, you know, I don't want to overwhelm people, but it can get as detailed as you want and as high level as you want too. So, you know, the same concepts can be applied for energy generation as well, or any other, you know, type of similar concern, you know, issue.
Thank you. Over to Tiril, yeah.
One more question, Dr. Lawson. In the use of causality in assignment, that means assignments, and then why can't the company use activity-based costing method? So, is there a connection to it, or is it it's a subset of it?
So at PACE, right, we consider ourselves methodology and vendor neutral. so the activity-based costing is fine. There's resource consumption accounting, which is fine. Again, we use the term driver-based costing, and so the important thing is to use an appropriate driver. So which basically means you're identifying the cost and effect relationship, right? And so activity-based costing has gotten a bad name in practice. It can be implemented well, it can be implemented very poorly. So if you use like the traditional two-stage activity-based costing, that's not really going to generate insights. But if you use like a multiple stage ABC system, that will give you the insights. Basically, it could be what we're talking about today. If you're identifying the appropriate drivers, you're tracing, you know, resources to HR, to the departments consuming it, to the cost objects. That's basically what we talked about today. So I hate to use ABC because it's a loaded term. B, can implement it well or very poorly. So we're talking about more these general concepts, but yeah, this, you know, implemented well, ABC is great. can generate insights. Absolutely. And that's activity-based management right there.
Correct, correct. And I think presentation, will it be shared or will be giving a link, Dr. Lawson, to this today's presentation? Will it be shared or will you be giving a link to your website to get this information?
Oh, well, there's that one link I gave to the ebook, which would be, I think,
Okay.
it's a great. Let me just put that back up. If people, should I put it back up? Let's see.
Last slide, no?
Let me find it again. So again, there's this ebook that contains a lot of this. So I think that would be a great resource for people to again, it's properly-analytics.org/ebooks. And it's, we have a lot of resources on that page actually.
Yeah.
So I would encourage people to go look at that.
We'll share the link with them from the CMA. So that's basically all on relevant questions, Professor Watawala. I think now we can, because of the time also is up, we can wrap it up.
Okay. Kausal, I don't know whether, do you have any questions?
No, that's fine. Yes.
Dr. Nuwan, anything further you like to ask?
No, I'm fine here, Professor Watawala. Thank you very much.
So thank you very much, Dr. Raef, for that very detailed explanation you have given. I'm sure that this needs much more further explanation, I think, because as to how really we can put it into practice. What we will do is we will also discuss with our Cost and Management Accounting Standards Board and see how we can bring this in, because Tyrrell is there, he is also a member, and we can also get the support of Dr. Nuwan, who's present here today. And maybe later in the event that if he needs any further information or details, that maybe the committee can arrange a meeting with you, so that then they'll be
Absolutely
able to do that, So once again, let me thank you, because you have been a great supporter of CMA Sri Lanka. You are a fellow member of our institute and supporting us in all these matters. And as I said earlier, maybe we will also get your input on our syllabus, which we are now looking at. And of course, Dr. Nuwan is also working on it. So he will also be able to be in touch with you. One of the things that what I would like now, that since this education part is also something that you take into account, what sort of areas do you think that we should cover now? Because since your profitability analytics is also there, and then of course the causality and ABC and other areas that come in for a management accountant, what sort of knowledge should be given to them?
Wow. Well, I've provided some feedback previously, but in our profitability analytics framework, and I think it's consistent with the vision of where finance needs to go to becoming business partners. And I think as finance professionals in the past have been too accepting of just operating in their little silo, and we need to work more cross-functionally within the organization. And our profitability analytics framework, not to push that too much, it encompasses 3 bodies of knowledge. It's managerial costing, which is our core competency, investment management, which we deal with somewhat, but also revenue management. And, if we really need to have some awareness of revenue management techniques. Not that we need to be experts in it, but we need to be able to work with marketing professionals and sales professionals. Someone, if the marketing comes up with, marketing plan, we need to help be able to evaluate that. They may not have the competency to understand the financial impacts of their plan. They may be just looking at they may just be looking at revenues, but what are the cost implications of that? And it may be not even just above the line, but what are the below the line, below the gross margin line? So I mean, it's a lot more that we as financial professionals can do to add values to our organization. So again, looking at comprehensively at the factors that affect profitability, and then be more engaged operationally, and that kind of related to this talk today on causality. We need to understand how organization works, and not just just stick with our financial models that are disconnected from operational reality. And of course, underlying all of this is analytics. We need to effectively need to be able to understand the key factors of our organization, what the drivers of our profitability are, and so on. So, and then of course those are the hard skills, and then there's the softer skills of collaboration, communication, influencing, and that's going to be of increasing importance as well as we go forward.
Thank you, Dr. Raef. Dr. Nguyen, do you have any comments on that area?
Yes, I think thank you very much for the insights. Now we are in the process of drafting the new syllabus for CMA, so that we have included, as you mentioned, that data analytics 2 courses will be coming in. Then again, we will actually have greater details in management accounting pillar as well. Then in addition, regarding the soft skills, I think we have separate soft skills on professional communication. So we have 3 courses coming in. So I'm sure that the new syllabus will have a lot of insights on causality and how it is can be incorporated into a professional accountancy course. Thank you.
Okay. Thank you, Dr. Nguyen. Thank you, Dr. Raef. So once again, let me thank you for making available your valuable time and to be with us. I know that you are a very busy person, and especially with the Profitability Analytics Center of Excellence, where you have a lot of work that you are doing. But I think this is also a very important topic for us, especially at this time, in this sort of situation, which we have never experienced, as to how the pace, the pace various programs could be used for the support of our business organizations. So we will certainly be in touch with you, and this causality is, I think, a very important area that we need to look at. But I'm sure for the students, this might be something still quite new, and we may need to do quite a lot of work in this area. And certainly, if there's anything, that we will get in touch with you. And let me thank you once again on behalf of CMS Sri Lanka, and look forward to continue our association with you and obtain your support in all our matters. So thank you, and all the very best.
My pleasure. Same to you all.
Thank you. Bye.
Okay. Bye-bye.